Hi, I'm Colleen,
I'm Matt.
and welcome to the next episode of
Mortgage Matters.
On today's episode, we're going to tackle different types of mortgages, and in today's real estate market, we've got some situations where we're back at multiple offers in a very short period of time, or something sitting on the market because it's overpriced and buyers are using their power. When you're looking for homes and all of these different factors come in, it can be really overwhelming. But one thing that can stabilize it is the type of mortgage that you're going for and the type of product that your mortgage lender can give you. And I want to talk to Matt today about some of those different loan types and what situations they're good for.
Absolutely. Yeah, there's a myriad of different loans across the board, and we're just going to cover kind of the basic ones that we run into 95% of the time. Maybe now's a good time just to touch on some different ones that we'll follow up on later on, but there's bank statement only loans that are good for self-employed borrowers. It's bank statement only, so you can give 12 or 24 months depending on your profile. You can get 12 or 24 months of bank statements, so no tax returns, no W-2s or 1099s,
Right.
which most self-employed folks don't have. So it's a way of still being able to qualify for a loan, maybe if you don't show a lot of earned income.
Right. You probably
Because
have a
you
lot
have
of write-offs as an
a
entrepreneur.
lot of business expenses,
Yeah.
correct. So bank statement only, there's bridge loans that you had mentioned to me earlier.
Yes.
There's all kinds of interesting products. There's second home loans and investment property loans, which you can still get in conventional FHA, VA, those types of things. But they're a little bit different. The guidelines
They're a little
are
bit tricky.
a little tricky. Yeah, the guidelines are a little bit more strict.
Yeah.
And then they're typically underwritten a little bit more stringently. So you may be required to come up with more documentation. But there's some, we call them a lot of non-QM loans. QM loans are qualified mortgages, which are the conventional types of loans that we're going to cover today.
Okay. Like
So,
FHA.
like FHA, VA, conventional. So the most popular loan or the most sought after loan, I guess, because you need a good credit, a better credit score and a good financial standing and or
Pretty clean.
above good financial standing, is just a regular conventional loan. A conventional loan is going to be for buyers. You can qualify for a conventional loan above about a 640 credit score. In today's rate environment,
Are these going to be fixed rate?
fixed rate, yes. In today's rate environment, a 642 credit score is going to get you a really high interest rate. So a lot of times, just because you're 642, it doesn't mean you have to go with a conventional loan. You
Right.
still might make a lot more sense to go FHA, which is a government-sponsored loan, which is going to have much better rates. There are some negatives to that, obviously. Otherwise,
Right.
everybody would just go FHA. So conventional, you're looking at 640 and higher. You have to keep under a 50% debt-to-income ratio. So taking into account all of your monthly debt, which would be car payments, student loan debt, credit card minimums.
This is why real estate agents tell you do not buy anything after you get pre-approved.
Yeah,
Don't buy anything.
and it literally
Like eat
still
rice and
happens.
beans, and when you run out of that, eat beans and rice.
Well, technically,
Just in the time frame that you get the mortgage till you close on the house.
yeah. You shouldn't be buying a house if you're on the beans and rice program. You should
Well,
be.
sometimes that's how you get your down payment.
Yeah, whatever it takes. But yeah, no, I've had people, like you'd mentioned in a previous episode, we're going to do a soft pull on the credit prior to closing.
Right.
Yeah, I needed a new car, $340 a month, and there goes the debt to income ratio. Because here's another thing, right? So monthly debt plus your future mortgage payment
Right.
is included in that, has to be 50% of your gross monthly income. And there's different ways to work out that income. We'll go into that in a later episode. If somebody comes to me with a $5,000 a month income, I'm trying to do math again.
Oh, here we go.
Here we go. Fortunately, I've got 5 fingers. So they come to me with a $5,000 a month income, okay,
Right.
and that's gross. We work off the
Right.
gross, not the net. let's say, so we can only spend up to $2,500
Right.
on the debt. We have to stay under 50%. And sometimes if they have a very low credit score and maybe the debt to income ratio is high and there's a lot of debt and there are no reserves, then DU, which is Desktop Underwriter, the National Automated Underwriting System, may come back and give us a refer eligible at 49 points. So we may have to sneak it down even lower. So that's not set in stone that you're good up to.
Right.
Certainly is the case with FHA, and that moves weekly. So once we pre-qualify a borrower, if they're shopping at the top of their budget, constantly checking to make sure they're still approved,
they can still afford it
before an offer goes in. So, okay, $2,500 our max. And I'm just using general numbers. These are not going to be accurate, but let's say we've got $500 worth of monthly debt. We have a $350 car payment and $350 a month credit card minimums. $500 a month. So now we're left with $2,000 a month to play with, because that's all we can borrow up to. Well, it turns out $2,000 a month with your principal and interest and your taxes and your mortgage insurance allows you to buy a $300,000 house. $300,000 house. Most borrowers don't want to go look at $200,000 houses, right?
Nope.
And you wouldn't. You know, especially in these markets, like, you know, 200 and less it's pretty rough. You're going to want to look at a 250 to 300, and you're going to look at 3 or 4 houses, and you're going to love the one that's 295 because it's nicer. And then so now you're shopping at the top of your budget. So that's your debt to income ratio, and that's why we definitely encourage people not to
incur any.
Just putting an extra $1,000 on a credit card and bumping up the monthly minimum from $50 to $100 or whatever happens could be the difference.
Like buying furniture for the home you don't own yet.
Yeah,
is a common one.
Yeah.
You know, people get excited, they get a little ahead of their skis, and
and then,
next thing you know, we can't buy the house because we bought the furniture.
They think, well, I'll go to Rooms to Go, right? Buy now, pay in
It
20,
still
48.
hits your credit.
It still shows up as debt on your credit, and it has to be counted within your debt to income ratio.
Right.
So getting a little involved there, but conventional, right?
But all of these things and all of this advice is to prevent foreclosures, to prevent you not being able to afford that home eventually by making a poor choice. Listen, it can happen like that, and maybe it's a medical bill. Life happens, right? But when foreclosures hit the market, it does affect every homeowner. And so part of our job and our fiduciary duty in our jobs is to prevent those things from happening. So when we're giving advice saying, when we do this kind of a mortgage, we really need you to be tight on your debt. And if, don't be accumulating anymore, be paying it off if you can.
Right. Well, and I was talking to a colleague about this actually a couple of weeks ago. That 50% debt to income ratio, that doesn't mean everybody should run their debt to income ratio up to 49%. Like that's the maximum. That's for people that are really frugal, don't go out much, eat at home, cook themselves, and save money and don't have, a ton of debt. That's the line for them.
To move your credit, actually, you should be under 30%.
I'm not that person.
Listen, and in this economy, it's really hard to not put something on a card, right?
Yeah, and I'm better than some, and I'm worse than a lot. So
like everybody.
So I don't need to be shopping up to 50% of my debt to income ratio. Anyway, that's so conventional. That's your debt to income ratio, and you've got the 640 credit score or more.
Yeah.
Other than that, you have to have 2 years of income typically. Mm-hmm. Fannie Mae and Freddie Mac are both conventional. Sometimes we'll run it through Fannie Mae and it will only require 1 year, potentially. Actually, on both of those, if you were a student prior and what you were studying was in the same field that you now work in, that can count as part of your 2 years. But 2 years of income and 2 years of the same type of income on all loan types. So if you're self-employed up until August of 2021, we need to wait until August of 2021 this year because you became W-2 before you'll be able to close on a home again. Again, in most cases, self-employed income, sometimes you can get away with 1 year of income.
Right.
but then typically you have to have owned the business for 5 years,
Right,
which
right.
means you would have more than 1 year of self-employed income. So that's conventional product.
Okay, Matt, so I know that part of our audience that we're hoping to gather from this channel is going to be first-time homeowners. And I kind of want to spend a few minutes on products that are specifically made for first-time homeowners and what those mortgages look like, what you have to do to qualify, and why they're a great product for first-time buyers.
A great question. So for conventional borrowers, there are a couple of, the main two programs are Home Ready and Home Possible. They're similar programs. They typically, special programs like USDA and Home Ready, Home Possible have income limits.
Okay.
And I think the county that we're in, I haven't come across one this year, so I haven't double checked. Typically the income limits and the minimum, the max loan amounts tend to go up with inflation. But the income limits for Home Ready, Home Possible were around 76,000. And it differs from county to county and state to state,
Right.
so it's always good to.
And if that was two young professionals, you know, starting their career, that would be a combined income for those two?
Combined income, yeah,
So
absolutely.
that's not really that
Yeah.
difficult to achieve for many of the young professionals
Not
today.
at all, yeah. I mean, and you know, if it's a 28-year-old couple and she works and he stays at home with the kids and she makes 75,000 a year, then
Let's go.
same thing, right?
Yeah.
So
Now, is it just people that have never owned a home, or is there a time frame that allows you to become a first-time buyer again?
So that's another good question. So a first-time home buyer is considered anyone that hasn't owned a home within 3 years. So if you've been renting for 5 years, but you own 3 homes, you know, over the last 20, 30, you are technically a first-time home buyer again. So you would qualify. There are income limits. There are also credit score limits. I believe it's 700 and higher.
Okay.
You have to have a 700 or higher to qualify for Home Ready, Home Possible.
So seniors maybe,
to get the,
if they were renting and wanted to buy again, they maybe even could qualify for an FHA.
you mean a
Or
Home,
for, I'm
home
sorry,
Ready, Home
I-
Possible? Yeah,
Yes,
yeah. I mean, seniors can qualify for
just about anything.
any loan
Yeah.
as long as they qualify.
Right.
Yeah. There's, I mean, and 2 18-year-olds can qualify for any loan.
Yeah, I
as
just
long
wanted
as
to
they
make the
qualify.
point that it doesn't, you know, it's not just stuck on
Oh,
young
right.
professionals, but because of that rule that if you haven't owned in 3
yes.
years,
You
that
could be 80
again,
and
you
be a
could
first-time
revisit
homebuyer.
this product if it works out for you.
You could have owned 15 homes in your lifetime
And still be a first-time homeowner.
Yeah.
It's kind of messy lingo, but
Who
we're
said
glad
this
that we're
industry is
clear.
confusing?
That's what we're here for, to clarify this kind of thing.
Yeah.
So you said 700 credit score.
700 credit score, income limit depending on counties and states, and then the interest rates for those products are much better,
Right.
typically, or better. Nothing's much better these days, but they're better. And then your mortgage insurance is going to be less too, even if you put down 3%.
Now, if I was, let's say, we're that 28-year-old couple, and my dad said, you know what, I'm going to give you $15,000 towards your home. Would that be a buy down on that loan?
On the rate?
Mm-hmm.
So a family member, and Fannie and Freddie have just changed their guidelines a little bit. It can be a close family friend now.
Right, I heard that.
So if you're engaged to someone, you could always get a gift from them, but you couldn't get a gift from their mom because
Okay,
they weren't
because-
technically family yet.
Right.
But if you've been engaged to the same girl for 3 years and you've been with her for 6,
Yeah.
you could make a case that the mom is a close family friend of yours
Right.
by then. So that rule's changed a little bit for that reason, because it makes sense.
And the buy down would just mean that your percentage points that you're paying on the money you're loaning is lower.
Yeah, so you can get a gift for a family member for up to 100% of the closing costs and 100% of the down payment.
Right.
On a conventional loan, you can only get 3% of the house value in closing costs. No, back up. I'm getting mixed up. That's seller paid closing costs. You can get up to 3%. So on a $400,000 home, a seller can contribute $12,000 max.
Okay.
Can't contribute more. So that's just a side note, but that's conventional. So up to, like I said, up to 100% of the down payment and closing costs can be paid, donated by a family member. And as a part of that gift money, you can gift buy down money as well.
Okay.
Or points. So let's say it's a $300,000 loan. If you want to pay 1 point, it would be $3,000,
right.
and that would buy the rate down by X amount of dollars.
Right.
So yeah, gift money can be can go towards buy downs.
Yeah, and that's a really helpful thing that, especially when you're first starting out and starting to pay your mortgage, having that rate buy down is a fantastic feature that you're able to take advantage of if you have some money coming from a family friend or
right.
a direct family member.
But it also depends, and this is where an experienced loan officer comes in. We're going to have that conversation with the buyers.
Right.
How long do you plan on staying in the home? Yeah. Because if I buy down my rate with $2,400, again, I'm going to keep the numbers real simple,
sure.
and it saves me $200 a month, I don't start winning for 12 months.
Right.
Okay, and I kept those numbers simple, but typically I found in my experience when I'm doing that math, okay, it's going to cost you $5,300 to buy it down. You're going to save $212 a month.
Right.
You divide 212 into 5,300, and I'm not going to try and guess what that is,
right.
but it's typically been, around anywhere between 40 and 55, 60 months.
Yeah.
So 48 is a number that kind of
right.
is, I usually throw out there as a general number, but if you know you're going to be there for 2 years or 3 years and then move on,
it's a great idea.
It doesn't make sense to buy it down.
Right.
Right, because you only start winning after the 48.
Right, it is a little longer haul game.
Yeah. So there's that to look at too. So the next product to talk about is FHA.
Yeah.
FHA is going to be, you can qualify. I mean, you can get an FHA loan with a 695 mid score, which is also qualifies for conventional, but you can't have too high of a score. You can have too low of a score. 580 is typically the number that's the cutoff for FHA. Now, we can go lower if it's a super solid file.
Would they need to have more cash?
Great question. Yeah, so it's all about your credit, your file, your profile.
Right.
Let's say you have a 565 credit score. And here's why it doesn't happen often, because if the debt to income ratio on your purchase was 26% and you earned $250,000 a year and you had $100,000 saved, it happens sometimes. You would think, well, that person's not going to have a 560 credit score, but it happens.
It does happen.
You can get hit, you can miss some payments, do whatever, and then have an amazing next 12 months.
Yeah.
Have plenty of reserves, good income, and your credit score is still rebounding. So in those cases, we can go below 580 and do a manual underwrite, but it does depend on the profile of the borrower. So for FHA, you're looking at 580 and higher. It's a government-sponsored loan, so it has great interest rates.
Right.
Much better interest rates, which helps with your price. One thing I didn't mention on conventional is you do have mortgage insurance.
Right.
If you put down 5%, your house is 95% loan to value, right? Until you get to 80%, you're going to pay mortgage insurance. Now, you can actually request mortgage insurance to be dropped off at 80%.
Isn't it after a year as well?
No, it's after it. Once it hits 80%.
80%, okay.
It could be after a year. Here's what happens, right? Well, in the market that we had a couple of years ago, when house prices went, if your house price went up by enough, you could ask your mortgage company to do an appraisal. If you're willing to pay for it, $500. If the house appraises all of a sudden, typically we expect our loan amount to have to go down to meet that 80-20 rule.
Right.
But sometimes the house value goes up enough that you can still meet it, and you can refinance your house, or actually just do a mortgage insurance modification with an appraisal.
And so that's once you own 20% equity in your home, you don't have to have the mortgage insurance.
You don't have to have mortgage insurance anymore. Now, side note, if you happen to be watching this and you're close to that number, you can request your mortgage insurance to be taken off at 80. Otherwise, it has to legally be taken off at 79. So they'll get you for a little bit extra.
Of course.
But you kind of have to stay on top of that. And honestly, most people sell a home and move on, a lot of
Right.
times before that becomes an issue, or they're in a position where they just put 20% down in the first place and then they're good to go. With conventional, the minimum you can put down is 3%,
Right.
depending on the profile of the borrower or borrowers. 20%. Once you get to 20%, you eliminate mortgage insurance. I have run numbers a few different ways. Here's a tip for loan officers that may be watching. Sometimes, if you run the loan at 81% loan to value to get in the home,
Right.
the interest rate is lower than if you run it at 80% loan to value for whatever reason. So
It's good fortune, don't question it.
So the mortgage insurance
Right.
may be, because you have to pay mortgage insurance on
Right.
that 1%, it may be $35 a month, but it's
Right.
going to drop off after 6 to 12 months or
Right.
whatever. And you may save more than that in the meantime with the lower interest rate.
Right.
So it's interesting once you play with the numbers,
When
you
you
find
have a
some
really
weird
good
stuff.
mortgage guy, that's what they can do. They know those little tricks.
Yeah, stumbled upon in many
Well, but it's
cases.
stuck with you.
Yeah, it's good to remember.
Certainly.
So that's your down payment. With FHA, down payment is going to be 3.5% or
Yes.
more. You can put down
Right.
more. Typically, if
But you have to have that down.
you have to have at least 3.5% down.
Yeah.
So on a $300,000 purchase, that would be $10,500.
Right.
Did that math quickly.
Yes, you did.
Didn't even take my shoes off.
3% of anything I can do.
Oh wow.
That's-
So that's 3.5% down, 580 credit score minimum, and then a lot of the guidelines are the same. There are some guidelines that are different, and you're just going to get into that with your loan officer at the time. But typically, credit score is going to dictate which of those two products
Right.
you fall into.
Right. Which one would work best for you and your budget?
Absolutely. And bear in mind, so the mortgage insurance on an FHA loan never drops off.
Right.
So, if the mortgage insurance is 0.85 or whatever it is, as the loan amount decreases, it's going to decrease, but you
It's
still
always
may
there.
be paying it forever. And that's why a conventional product is better in that regard.
Right.
So pros and cons to all of them. You may not be a conventional buyer. It's
Right.
perfectly okay to be an FHA borrower. It's a
Right.
fantastic loan, and
Right.
a lot of those loans are done every year.
Yeah, it's a secure product, and oftentimes they're the first-time homeowners things. You don't generally stay in your starter home as long as you do maybe your second or third home.
Right.
When you've got a family started, or a solid career and a commute, and
Careers moving you around.
those kinds
Yeah.
of things. You generally, your first home is kind of one you kind of learn a lot about home ownership and
Yep.
what it takes and all of
Yes,
that.
you do.
And then as you move on, then you generally stay in a home for a little longer periods. But so we wanted to differentiate why those first-time home mortgages, first-time buyer home mortgages, are a little bit different, and how they carry the mortgage insurance. And like Matt said, once you sell that home with your FHA, with your the Home Ready or Home Possible, your next mortgage, you probably won't have to pay that mortgage insurance.
Hopefully,
Yeah, well,
Right.
if you've
Yeah.
been good.
if you've planned and executed.
Right.
So the next one I want to just touch on briefly is USDA. We're kind of on the edge of it out here. If
Yeah.
you can go to USDA, the
It's
USDA.
Spot Road and north of here
Yeah.
that is eligible for USDA loans right in this area.
Yeah. You can actually just go to the USDA website and click on a map,
Yeah,
or
it'll
put
show
in
you.
your zip code, and it'll show you. It's a rural development loan, so it's going to be rural. There's a weird little piece that snakes up, and I'm doing this for the camera, out of Atlanta up like 85 and around Gainesville,
Right.
weirdly. So
Right.
Gainesville is inside, is considered urban, and then outside
The
of Gainesville.
Lula area, all of that. Probably.
Outside is rural. Yeah,
Yeah.
that's rural. Lula's definitely rural.
Yeah.
Lula Golf Course,
Yeah.
fantastic. cow pasture. Used to play there in college. Very cheap. So and then 369, like you said, Spot Road coming along this way and heading towards Canton along Highway 20.
Yep.
Typically, stuff above that is going to be USDA eligible, and it's a rural development loan. So your total household income is the limit.
Right.
So if you have a kid that works at McDonald's that lives at home, that's going to have to be included in the household income. It is 620 credit score or more. And there are a number of different guidelines. Again, one that always sticks out in my mind is that you have to have had historically, it could be 5 years ago, but you have to have had at least 2 lines of credit, revolving credit for
So
12 months.
Credit card,
Yeah, for 12 months or more. So 2 cards
right.
for 12 months or more, and you can have had that in recent.
Right. Just to show payment history,
Yeah.
I'm sure.
Yep. So that's USDA.
But they're pretty cool, and a lot of people don't even know.
They're great loans. Again, it's a specific type of borrower.
Yeah.
You've got that income limit, which is relatively low. You've got the credit score, which is right there. Typically, it's going to be someone with, not a ton of credit,
right.
not a ton of debt, rather.
Right.
An average but steady income.
Right.
An average is a undefined term.
Right.
Yeah. And the really nice thing about USDA is you can do it zero down. Zero down. I actually had a borrower that I don't know if the closing attorney screwed the pooch on this one, because I don't think you're supposed to get money back at closing. But I had
the buyer.
I had a buyer do a USDA loan. I had a buyer do a USDA loan. They got $7,000 in seller-paid closing costs.
Okay.
It was zero down, and his closing costs were like $6,930 something, and the closing attorney cut him back a check for the difference. So he actually bought a home and made enough for dinner.
I don't think
Yeah.
that's supposed to happen.
Yeah.
Typically, the buyers do not get a check
Cash
or
back.
cash or anything.
Well, unless
I
unless
mean, you get buy
unless they
down or
wire
you
too much
get,
money to
you know,
closing.
seller
Sometimes
incentive.
the buyer will say, the final closing disclosure is getting balanced super late,
Yeah.
and they're like, I need a number to wire, and you're like, well, it's probably going to be around 12, just wire 15.
Yeah.
And then they'll
And
get
they'll
a check
cut
back
you.
at closing. So you can get a check back.
It's not normal.
It's not normal, and I think it may just have been the situation. It
But
wasn't that.
it makes sense though what you were saying about the USDA loans, that it's going to be the whole household income,
Correct.
right? And it's going to be in a more rural spot, so it's not like it's going to be big giant homes and probably more property than home,
Yeah.
and something that's more affordable with the zero down. I think there is a sector of the population that we can really help with those loans. And I know
Absolutely.
that by saying that, I also need to give the caveat that I believe there is a limit as to how many loans the USDA gives to an area every year.
I'll take your word for it. One point that I will make about USDA loans, we can always get loans closed very quickly.
Yes.
I've done 8-day closes with an appraisal. But with USDA, one thing to bear in mind is that on the USDA website, I think it's top left-hand corner, it will say, we are working on files from February the 23rd. You do the math. It's March the 15th today. So
A little longer close.
So the file has to go to USDA to be approved. And those turn times, I'm going from memory during COVID.
Right.
You remember that? So turn times were, they got up to in the 40s, I think, days. So you knew it was going to be a long close.
Right.
So the point is, this is going to be a 30-day or more close,
Okay.
and we're going to be pushing pretty hard early on to get all the documentation in, get the file submitted, get it through underwriting, get it cleared, and get it off to the USDA so that they can.
And that's because a
approve it quickly.
pre-approval or letter is only good for
90 days, depending on the lender. So 90 days, yeah. Credit's good for 60 days. 60 days on the pre-approval.
I know some have pushed to 90.
Some push to 90, and then credit is 90.
Yeah.
Your credit report has to be renewed. So
Just good to have those timelines in mind for all loans, actually. So
we're kind of breezing over these loans today and giving you just the cliff notes. Please,
go
if you
more
have
in
any
depth.
questions about anything specific, as always, just leave a comment or reach out to us personally.
or if we weren't clear about something, let us know, and we'll work on it. We'll make it a little bit more clear in the next one.
Absolutely. So VA loans, VA loans
Our
are
veterans.
for military veterans. They can also be zero down. They don't have mortgage insurance.
And can't you borrow up to 100% of your home value on VA?
Yes. Or you can put zero down.
Well, I guess 6 of one, half a dozen of another, isn't it?
It is.
Sounds better my way.
Yeah, I like your way. You can borrow up to 100% of the value of your home. Or if you don't like to do that,
Just put zero down.
you can put zero down.
I'm blonde. I'm blonde.
So
I'm sorry.
that's okay.
Yeah, that was pretty funny.
Yeah. So
I like
yeah, you can borrow up to 100% of the home value.
Or not
on
put
the loan.
anything down.
Or you can, it's also zero down like USDA. But so conventional loan limits have been set this year. VAs don't actually have a debt to income ratio. FHA is 55%
Yeah.
debt to income ratio. USDA is 42 back end, 37 front end, I think. So 37 is the most you can borrow on a house.
Okay.
So that's your housing
Gotcha.
ratio, and then 42 is the total ratio. I think it's 37.42. I'm doing this on the fly.
Well, we'll clarify that.
Yeah.
In the description below.
But VA, you can, as long as you get a underwriter approval, the automated underwriter system, you can go above 50, 55. I think I've had approvals up to 65%. Wow. And typically it's high income earners too.
Yeah.
You'll do loans for generals.
Yeah.
That were in the military for, did two, 3 tours, and in
Another
lifers,
career
and and then they come out and they're politicians or whatever.
Right.
And they don't make much money. So the VA loan is a fantastic product.
Yeah, it is.
Again,
It's a great one for our veterans, and I do hope that any veterans watching will take advantage of that benefit. It
Absolutely.
really is a great mortgage product.
yeah. So the minimum credit score for a VA loan is going to be 620, same as the USDA loan. So that basically covers credit score. There's no income limit. There's no front end, back end ratio limit, technically.
No down payment.
No down payment. Or you can finance 100% of the house price.
I'm blonde, sorry.
And again, there are guidelines, so it has to be underwritten. Rates are typically very good. If you put money down, you can still put down 20, 30, 40%. You're typically going to get a better rate. Rates are always based on the risk profile of the file. So credit score is an indicator of risk.
Yeah, and your loan to value,
Loan to value is an indicator of risk.
Yeah.
Yeah.
So,
because if you forfeit on the loan, it's not so much that you're not going to forfeit on the loan, but if you do, they're more likely to be able to get their money back when they sell it,
the home.
sell it to the bank. So that's a VA loan. Other than that, a jumbo loan is anything over the conventional loan limit. Jumbo loans are usually, depends on which investor you go to, but they're typically going to be up to 1.5, 2 million, and then 2 million and above. So there's different types of jumbo loan. And a lot of lenders have very competitive rates on jumbo loans.
Yeah. Particularly in this area, we have a lot of horse farms, equestrian places. We have a lot of lake homes that all qualify in those price ranges. And
I don't know about now, but a number of years ago, Hall County had more $1 million homes than any other county in Georgia, and it was because of the lake.
Right.
Yeah. Jumbo loans. Jumbo loans have a very strict underwriting.
Yes.
So this is tricky. I don't know how to say this. My jumbo loan borrowers are typically get it done quickly, make it easy. I'm busy.
Yeah.
I'm a CEO. I'm a doctor. I'm a whatever. That's the nicest way to say that. But no, it's understandable. They are busy and they want things done quickly. And so it can oftentimes be frustrating. So it's important if you're a loan officer to set the expectations early with a jumbo loan.
I am going to need a bit of your time.
Yeah, we're going to need some time. There's going to be some homework. Once we submit I'm going to ask you for absolutely everything I'm going to need.
Yep.
And then once it goes for underwriting, I'm going to need more.
Yes.
Yeah, so that's always a little curveball.
That's a lot of money.
Yeah, it's a lot of money. So it's underwritten very, very strictly.
Right.
But, it's a fantastic product. Jumbos typically are going to require at least 10% down. There's no mortgage insurance, and rates are a little higher again because they're a bit riskier. But jumbo buyers typically tend to expect to buy to pay. They tend to buy down rate.
Yeah.
I mean, most jumbos just kind of, you assume that there's 1% baked in points to get the rate lower.
And these are generally not home buyers that are strapped for cash.
No, hopefully not. Right? If you're buying $1.5 million home and the loan amount's $1 million, you can expect 1% in additional. So $10,000 to buy down the rate is going to get you a much better rate. And if it drops your rate by 0.5%, it could save you $500 a month.
And a lot over the course of however long you own the home.
Of course, but if you pay $10,000 to get there, that's 20 months at $500 a month, and then you start winning. So again, it's a case of assessing whether or not it makes sense to buy down. But a lot of jumbo buyers expect to pay some points to get the rate a little bit lower. So it's a little bit more digestible. A lot of people have enough money to buy the rate down with an extra $20,000, $25,000, $30,000 at closing, which I've seen. And it's like, good Lord, why would you do that? Why wouldn't you keep it in your pocket? Well,
if they plan on staying in the home, it may make sense for them.
If it takes their mortgage from $4,300 a month to $3,100 a month, that's a car. Yeah, that's 2 cars. Yeah, not for jumbo buyers. But that's 1 Lambo or 2 of our cars. Yeah, that's how that works. So anyway, it's a good product. Hopefully, I'll have an opportunity to talk to you about it one day.
Yeah, that'd be great. We want to get everybody there.
Things are going great. But that's, so we've covered conventional, home ready, home possible, FA, VA, USDA, jumbo.
Yep.
And those are the basic types of loans that 90% of borrowers are going to kind of fall into those categories. We'll cover other specific loans that we mentioned earlier in future episodes, but that's...
Yeah, there's different mortgages. If you're let's say you want to make a passive income. Passive income means money that you make by not really doing anything. Basically, paying a mortgage would be the verb there.
Yeah.
The action item. So when you're buying an investment property, that's a different kind of mortgage. Not one that we've covered today, but that's what Matt's talking about. We're going to talk about things like that. A bridge loan, when you're going from one home to another, and you know.
That's a different type of loan.
It's a different type of loan.
An investment property or a second, it's the same type of loan, right? Conventional or VA, but it's going to be a ton of different other guidelines.
Exactly.
You need reserves. It's a higher risk, right? When the
bank wants to know whether you're living in the home or not.
Yeah, when the market hits the fan.
Yeah,
it's a nice way of saying it. Then and you own a primary home and a second home and an investment home. Which one are you going to start paying the mortgage on first, right? So that's all part of that risk profile and what helps to affect the rates associated with each loan.
And there's like construction loans, things like that. We're going to get into those in a later episode, but there are products for just about every situation that you find yourself in when you're looking to buy or get into a home and stabilize that monthly payment, from rent that could go up or down into a mortgage payment that's going to be the same, something you can count on.
Yep.
And that's what can offer some stability in this crazy market, like we said at the beginning. And I'm so glad that we got to cover these very, very common types of mortgages.
Yeah, absolutely. Residential property on a piece of land with a USPS address, that's it. And then, primary, second, investment, different types of loans. But that's basically it in a nutshell.
Yeah, and as always, if you have any questions, please put them below and we will answer any of them. And our information will be in the description box. Well, that's going to wrap it up for this episode of Mortgage Matters. But as always, we want you to hit the like, subscribe, and notification bell and share this with all your friends.